Yes, dear. Sorry, feeling well. And after that, my USB has not been working. Okay. Students, if you have any confusions regarding previous lectures, you can just ask me. If any one of you is having any confusion regarding previous lectures, you can ask me. Your confusion? Let me just have a look at your questions, Sameha. Sameha does have a problem in some revision kit question. Sameha, yes. Previous? Which one? Impairment? Reversal of impairment, you asked. Okay. I will be clearing that too. And yesterday also you asked me some questions, Sameha. Okay, you were asking me about the cash flow. Is it? So coupon rate has been 5% on 10 million. So take 5% of 10 million, you are going to get the yearly cash flow. It would be 500,000. Got it? Reversal of impairment, I will explain once again. Anyone else having any confusion? Did you people revise the previous concepts? All of them? Sure? No? Not all? Except? Try balance. Okay. But you need to try balance because one full-fledged question you can expect from that portion. Okay. Yes, anyone else? No? Okay, now students, today the topic which we are going to start is an interesting one. It is the last chapter of our book, chapter number 22, which is regarding interpretation of the financial statements. In this particular chapter, we are not going to study any kind of international accounting standards, not any kind of international financial reporting standards as well. This is just about the interpretation of the financial statements. We do know that financial statements are being made so that users of the financial statements can analyze them. We all are the users of the financial statements of any kind of an organization. We being bankers, we being tax consultants, we being competitors, we being ordinary persons, or any ordinary kind of a person or usual kind of a person is going to be interested in the financial position of an organization. We want to know about the financial position of any of the organizations which are running around ourselves, because we do have our own certain benefits in that. If we are a tax calculating authority, or if we are a tax authority, obviously the organizations must have to submit tax to us. We have to see the financial statements of the organizations to analyze that whether the tax collected by us is the actual tax liability levied on the organization or not. If we are a government, we are interested to know about the financial position of a company so that we can see that whether the environmental protocols are being followed by the organization or not, or how much the organization is investing to make the green environment safe for everyone. So being any kind of a person, say creditor or debtor, receivable or payables of the organizations, we are going to have our certain kinds of advantages in analyzing the financial statements. So this chapter is going to give you a learning that you being an analyzer of the financial statements can interpret the financial position of the company. Which methods can be used by any of the users to analyze the financial statements of an organization. This chapter is going to give you a learning regarding. So the chapter which we are going to study today is interpretation of the financial statements. Whenever we are talking about financial statements, there are 4 financial statements about which we are talking. What are the names of those financial statements? Statement of profit or loss, which is also known as income statement. Statement of financial position, which is also known as balance sheet. Statement of changes in equity and statement of cash flows. The first 3 statements are being prepared on the basis of accruals. The concept of accruals is known to us cost. The concept of accruals tells us that all the incomes have to be recorded in our books of accounts, whether received in the form of cash or not, and all the expenses which are incurred in an accounting period have to be recorded, whether paid in the form of cash or not. The first three financial statements are based upon the accruals concept, while the fourth financial statement, that is statement of cash flows, is not based upon this principle. That is based upon which principle? Cash principles. This is the only financial statement which is going to follow the cash basis of accounting, in which we are supposed to record the transactions when we are actually paying or receiving the cash, rather than just on the occurrence of the transactions. So this is the brief history of the financial statements, we can say. Now we are going to see that which methods, which tools can be used in order to interpret the financial statements. You need to consider, you need to see from the perspective of an ordinary user, that you being an ordinary user of the financial statement, how are you going to analyze the financial situation or the financial health of a company by using different tools. So let's start this chapter. In this chapter, we are primarily going to learn about the ratio analysis. Ratio analysis is one of the tools which gives us the capacity to analyze the financial health of an organization. There are so many other tools as well, which the management accountants or which the ordinary accountants of the organizations will be using to analyze or interpret the financial statements. But ratio analysis is the most popular one and the most used one, which is going to be used obviously to analyze the financial position of any organization. So ratio analysis is going to give us the capacity to analyze the financial position of the company from four perspectives: profitability, liquidity, stability, and the investors. And under the this portion, we are going to learn about the limitations of the financial statements as well. We are going to use the ratio analysis in order to analyze the financial position of a company, but there are some drawbacks of this particular method as well. We cannot always deeply analyze the financial position of the company only on the basis of the financial statements, because there are some limitations. There are some disadvantages if our analysis is just based upon the financial statements of a company. From the exam perspective, students, one question is must to be coming out of this chapter. One question is must to be coming out of this chapter. Sometimes full-fledged 20 marks question could be coming out of this portion. Or otherwise, any kind of objective case question could be coming out of this particular portion. So they will be giving you a scenario, and from that particular scenario, 3 to 4 questions could be asked to you. This is the one scenario under which this question could be asked. On the other basis, full-fledged question could be asked out of this portion. Moreover, in the examination, you will not only be required to become number crunchers. You will not only be required to make the calculations, but you have to comment on your calculations as well. Obviously, if we are concerned about calculating ratios, there are calculations involved. But what you have calculated, what is the meaning of that calculation, you will be required to elaborate that as well. And that is particularly known as analysis. When you will be becoming any kind of users of the financial statements, you will be required to analyze the financial situation of the company by commenting on the calculations which you are going to make. So what you are required to do, you are required to learn to comment on the calculated ratios as well. You are not only supposed to learn about the calculations, but what are the meanings behind those ratios you are also supposed to be learning. Clear? And this will also not be helpful for you over here in F7 only, but when you will be finishing your all papers up to F9, obviously you have to submit one thesis to get the BSc in Applied Accounting as well. Over there also, this is also going to be very helpful. There is particular one topic on which the students do make their thesis, and over there again interpretation is going to be required. Okay. Now, what your slide says, interpretation of the financial statements, ratio analysis. As we have discussed, that ratio analysis is one of the tools which is applied on the financial statements of the organizations to learn to analyze the financial health of a company. How well a company is performing, we are going to learn, we can analyze with the help of the ratio analysis. We have so many other tools as well to analyze the financial position or the competitor's situation or the competitor analysis of the company as well, which you are going to learn in the future. Say, for example, SWOT analysis. Do you know what SWOT analysis? Then we have Porter 5 forces. Then we have BCG metrics. One of the important one, Mendello metrics. So all of those tools, yes, dear, you want to ask it? So all of these tools are basically to analyze the situation or the position of the company in a market. But ratio analysis is one of the most important, renowned, and most used one analysis. Moreover, ratio analysis just give us the capacity to analyze the financial position of a company, while other tools can give us the capacity or the eligibility to analyze the non-financial position of the company as well. How well the company is performing from the non-financial perspectives also we can analyze with the help of the other tools. Whereas ratio analysis is just for analyzing the financial situation of the company. How well the company is performing from financial perspective is going to be analyzed with the usage of ratio analysis. Under ratio analysis, we can analyze the financial situation of a company from 4 perspectives, which are going to be covered under these 3 headings: performance of a company, position of a company, and position of the company in regards to the investor's point of view primarily. So under all these 3 portions, we are going to learn about the formulas of different ratios, which are going to be calculated and then will be used for the analysis. So for performance, this looks largely at the statement of profit or loss and associated ratios. When we want to look about the performance of a company in any accounting period, we can use the profitability ratios. So the portion of the profitability ratios is going to give us a help to analyze the performance of a company in any accounting period. Say, for example, if we want to know that how profitable the company has been over the period of time, it means that we are trying to judge the performance of the company over the passage of time. And the type of the ratios which can help us in this regard are known as profitability ratios. So to summarize the fact, profitability ratios are used to analyze the performance of a company over the passage of time. They say such as profit margins. What are profit margins? You generally know about those. What are profit margins? Gross profit margin, operating profit margin, net profit margin. We have return on capital employed. What is return on capital employed? Operating profit divided by capital employed of the company. Then net assets turnover. So these 3 important ratios will be helping us to analyze the performance of the company over the passage of time. Then this section looks at the results that the business has generated in a year. So this performance or the profitability ratios will be calculated by basing our calculations on statement of profit or loss. The figures which we have to put in our formulas to calculate the performance of the organization will be taken out of the income statement. All the figures will be taken from the statement of profit or loss, primarily. Because in return on capital employed, few figures have to be taken from SOFP as well. Then if we do want to look at the position of a company, position of the company means that at one single day, at the end of the financial period, at the time at which the balance sheet is being prepared, what has been the position of the company? How much cash flow the company is having? How much total cash the company is having in its bank? How much receivables the company is having in its accounts? How much payables are there? So this is the position at one day. That is at the end of an accounting period. Do you know when you prepare the balance sheet of an organization, what headings do you give? The name of the company, statement of financial position as at year ending date. It means that balance sheet gives you the financial position of the company for one day. Where has been the company standing at one particular day, that is at the end of an accounting period when you do prepare your financial statements. So the figures which you are going to put in your ratios in order to calculate the position of the company will primarily be taken out of the balance sheet. So over here, we are going to calculate about the liquidity ratios. If you can recall your F3, F2 as well, liquidity ratios, then quick ratio, asset test ratio, which is also known as current ratio. So these are going to give you an analysis out of the position of the company. So they say this looks at the statement of financial position and the associated ratios. This could be broken down into short-term liquidity, looking at working capital, and long-term solvency, looking at the levels of the debt. So we are going to cover gearing ratios in it as well. We are going to cover working capital ratios in it as well. What is a working capital, students? Can anyone tell me? Sorry? You want the format? No. Just the definition of a working capital. What is a working capital? Yes, you are very right. Yes, Ali. Yes, you were right. Basically, working capital is the capital which is required for day-to-day expenses of the company. The capital which is going to be used in the day-to-day expenses of the company is known as a working capital. Excellent. Yeah, I'm very happy that you know about this. That is why in formula, we do say that the excess of current assets to current liabilities is working capital. What is the formula of working capital? Current assets minus current liabilities. It's a rule of a finance, students. It's an extra knowledge. In this chapter, the extra knowledge which I will be giving to you, you will be using that knowledge to comment in your exams. In the ratios, you will be using that knowledge to comment because it will be giving a good impression to the examiner that the students are having a knowledge of these things. And only in this way, you will be able to gain the marks in this portion. It's a rule of a finance, students, that whatever current liabilities of the organization have to be fulfilled out of the current assets. And long-term liabilities have to be fulfilled using the non-current assets. We should not be taking a long-term loan in order to fulfill the payables payments. The payables have to be paid. That is why we are taking a long-term loan. This is wrong. So the excess of the current assets to the current liabilities, whatever we are having in excess of the current liabilities, will be used in our day-to-day expenses. That is a working capital. Then the last one, investors. This looks at the items that would specifically matter to investors. This will cover items such as share price, dividends, and earnings. So in this portion, we are going to cover those ratios which are of primary importance for the investors and potential investors of the company. Those who are already been investing in the company and those who are interested to invest in the company will be using these ratios. So they will be using the ratios such as earning per share, dividend yield, dividend per share, etc. So these will be primarily used by the investors and potential investors of the company. Now, students, one by one, we are going to look at the different ratios. The first ratio analysis which we have to cover is in regards to the performance of a company. As we have discussed, that performance ratios will be calculated on the basis of statement of profit or loss. The figures which we are primarily going to use under this portion will be taken out of the income statement. Under the performance ratios, we have so many different ratios, but few are covered in your book. When actually in a practical life, you will be analyzing the financial health of a company, you can make your own ratios as well. What is a ratio, students? Ratio tells us the relationship of two or more items in your books of accounts. What is the ratio analysis which you have to do in your financial statements? You are trying to learn, you are trying to analyze the relationship of two items in your books of accounts. If your revenue is increasing, how much proportion of the revenue is increasing in regards to the cost of goods sold? This is, what is this? This is gross profit margin. So when you are trying to find the relationship of two items or more items, it is known as a ratio analysis. So you can make your own ratios as well in order to analyze the financial health of a company. So few of the ratios in regards to the performance are covered in your book, but this is not an exhaustive list. There can be more ratios as well. When you are required to calculate or analyze the financial performance of a company, you can use these ratios. But one more thing which you can use is the analysis of the revenue. In an exam situation, you will be facing the financial statements. And on the financial statements, you have to apply these ratios by yourself. So when you have to cover the performance area, the first ratio which you are going to apply is in regards to the revenue. You are going to see that how much revenue is being increased or being decreased from the previous years. And ratios are not going to be calculated on independent basis. Ratios have to be compared from the previous year's results or the results of the competitors. On the self basis, on standalone basis, they will not be having any usage. Say, for example, if you are calculating the gross profit margin of 12% and you are very happy that your gross profit is more than your cost of goods sold, you are very happy. But if you find that in the same industry, the competitor has made the gross profit margin of 24%, then your happiness is going to become lesser, is it? So the comparison of the ratios is very important. So all the industrial averages or your own previous results have to be compared with your current results if you want to make your ratios more advantageous. So the first ratio under the performance is gross profit margin. The formula of the gross profit margin is gross profit divided by sales revenue. What is gross profit, students? Gross profit is sales revenue minus cost of goods sold. Very good. So gross profit margin tells you the relationship of gross profit to the total sales revenue of the organization. Under cost of goods sold, what do we have? Under cost of goods sold, we have opening inventory, add purchases, add direct expenses, minus closing inventory. Possibly, we are not concerned about opening inventory, purchases, and closing inventory. But while we are calculating the gross profit margin, we are concerned about direct expenses. How well the company is able to control its direct expenses is going to be primarily analyzed in gross profit margin. If the organization is not having a control over to its direct expenses, obviously gross profit is going to decline. The more the cost of goods sold, the lesser the gross profit will be, is it? So if the organization is not having a proper control over to its direct expenses and they are increasing year-on-year basis, gross profit will start declining. And when the gross profit is going to decline, your gross profit margin is also going to decline. If the proportion of the gross profit is more than the sales revenue, your gross profit margin will be high. And the proportion of the gross profit margin is only going to be higher when the organization's direct expenses are lesser. So when you are going to analyze the gross profit margin, primarily you are going to see that whether the organization is having a control over to its direct expenses or not. Moreover, in one more case, the gross profit position can look a good one. What is that? If the organization is having a lot of closing inventory. If the organization is having a lot of closing inventory, the organization was not able to sell its closing inventory, all of its inventory during a year. A lot of closing inventory will be there, which is basically not a good thing. Is it a good thing? Because with the passage of time, the organization's inventory is going to become obsolete, outdated. Or if it is perishable, then obviously it's more worse condition. But in that case, also your gross profit margin will look a favorable one. but not in all the cases. Because if there is a lot of inventory, then how the sales revenue is going to increase? Is it? So you have to see from the different perspective after calculating gross profit margin that what has been the reason behind the increase or decrease in the gross profit margin of the company. You have then to compare your gross profit margin with the competitors and from the previous years as well. So what is the gross profit margin? It is gross profit divided by sales revenue multiplied by 100. The answer to this ratio will be in the percentage form. All of the ratios which you are going to calculate under performance, except net assets turnover, will be in the percentage form. So what your book says about it, this is the margin that the company achieves on its sales, and it would be expected to remain reasonably constant. Reasonably constant means that there could be 1% or 2% increase or decrease. If the increase or decrease is more or lesser than that, then you have to seek deeply that what are the reasons behind it. Since the ratio is affected by only a small number of variables, a change may be traced to a change in selling prices. So a change in the gross profit margin can be due to the change in the selling prices also. Obviously, if the selling prices are increasing, it means that the gross profit margin is also going to increase. The sales revenue is going to increase. But if the selling prices are increased due to the increase in the cost of sales, then your results are going to remain constant. If the reason to increase the selling prices by the company is that because the company's cost push inflation is there. What is a cost push inflation? Do you remember? This is a concept of BT. Cost push inflation. When the organization is increasing its selling prices because the cost of goods sold is getting increased, that is a cost push inflation. Increase in the selling prices, the prices are rising because the cost of the goods sold is rising. So if that is the reason behind increase in the selling prices, then more or less your results are going to remain the same because the change in the selling price is going to be cut by the change in the cost of goods sold. So one of the reasons behind the change in the gross profit margin can be due to the change in the selling price. So they say normally deliberate through sometimes unavoidable, though sometimes unavoidable. That is because of increased competition or entry into a new market. So if you are going to see for the reasons in the examination portion, they are going to tell you that this is the this is the detail of the company for a year. So if they are going to tell you that there has been an increased competition, obviously when there is an increased competition, the organization sometimes decrease the selling price. Is it? And if they are entering into the new market, they can use different strategies. There can be a penetration strategy as well. Market penetration strategy. What is a market penetration strategy? Older concepts. All are the old concepts. Market penetration, yes, Ali?
Penetration pricing.
Penetration, yes. What is the penetration pricing? When in order to penetrate the market, you are making your sales prices very lesser. This is the market penetration pricing. Okay. So if organization is entering into any new kind of the market in order to grab the greater share of the market, if the organization is making its introductory prices very lesser, the selling prices are going to reduce. But it is going to be affecting the results only in the starting years. Once the organization will be able to grab a greater share, in the future its sales revenue is going to increase. So again, if market skimming pricing is being used, this is another strategy in which instead of making the prices lesser, the organization will enter the new market by taking the larger amount of prices. The sales prices are going to be higher in that case. So when the organization is going to enter the new market, maybe in the start, the selling prices are higher, so that the competitors obviously are going to feel the product less attractive. Is it? or if the people are brand conscious, they will be attracted towards a particular product. They will be having a perspective that the organization is having a good quality. That is why it is having a higher price. After having a higher price for a few time period, certainly the organization is going to reduce the selling prices. With that sudden decrease in the selling price, a lot of people will be attracted towards that product. This happens when the organization does offer the deals. Once that a lot of crowd is going to be attracted towards the product because of the lesser selling prices, the organization is going to skim that all. This is a concept which we use for the skimmed milk as well. What is a skimmed milk? We do skim the milk after, taking all of that fat out of it. So this is what the organizations also do. When a lot of customers get attracted towards the product, then they do skim those. They do take the advantages out of those. Then the change in the gross profit margin could be because of the sales mix. And this is also a deliberate strategy by the organization. Say, for example, if the organization is having 3 to 4 products in the market, for their own, product A, B, C, and D. Maybe the price of the product A is being deliberately made high so that the customers could be attracted towards the substitute product B. The price elasticity of demand. Sorry? Economics, yes. But we have discussed it in BT as well. So what has been happening in the price elasticity of the demand? If it's been for the substitutes, cross elasticity of demand. When the price of one substitute is going to be increased, the demand of the other substitute is going to increase. The demand of the other substitute is going to increase. For the same product, price is going to be increased, demand is going to decrease. But for the substitutes, it is going to increase. By increasing the price of one substitute, the demand of the other substitute is going to increase. This is the cross elasticity of demand. So sales mix, this is also an often deliberate strategy, company discontinuing some products. And purchase cost. What is the purchase cost? This is about the direct expenses. All the costs which the organization is doing on the purchases or manufacturing of the goods or services manufacturing of the goods is known as a direct expense. Is the cost of the purchases. Say, for example, carriage inward. What is the carriage inward? It is the transportation cost on the purchases. The cost which you are paying to your sellers, to your suppliers, so that goods can be supplied to your warehouse is known as a carriage inward. And carriage outward is the cost of transport which is being incurred on the goods to be delivered from your premises to the premises of your customer. So the carriage which is being paid on the sales is carriage outward, that is an indirect cost. And carriage inward is the one which is being paid on your purchases, that is a direct cost. So purchase cost including carriage inward or discounts. Which kind of the discounts? Trade discounts or settlement discounts? Two types of the discounts are there. Cash discounts and settlement discounts and trade discounts. Which types of the discounts are going to affect the purchase cost? Both discounts. Both discounts are going to affect the purchase cost, but primarily the trade discounts. The settlement discounts are usually being calculated and written and recognized under the indirect costs. Okay. Anyhow, trade discounts are going to be affecting the purchase cost. The more the purchase cost is there, the higher cost of sales is going to be there, and it will be reducing your gross profit margin. Production cost. All the costs which the organization is spending either on purchases or the manufacturing will also going to increase the cost of goods sold.
Don't they use cost plus pricing there?
Sorry?
Don't they use cost plus pricing there?
Cost plus pricing? Cost plus pricing will be used in any case. Cost plus pricing will be used in all the situations. Are we going to use cost minus pricing anywhere? Are we going to sell the goods at the price which is lesser than our cost? So whether it is penetration, whether it is skimming or any other kind of the pricing, it will be cost plus pricing. Cost plus pricing is cost plus profit is equal to selling price. So the organizations obviously have to set their selling price by adding some kind of the profit margin in that. Okay. So in any case, cost plus pricing is going to be used. Okay. So production cost, material, labor, or production overheads is also going to increase the cost of goods sold. So you have to analyze that what is the position of these costs and what is the major reason behind the increase or decrease in the gross profit margin. So you will not only be required to make the calculations, but you have to see the reasons behind the increase or decrease. Okay. So this is gross profit margin. Now we are going to discuss about the operating profit margin. Students, operating profit is a term which is used for profit before interest and tax. What is an operating profit? It is profit before interest and tax. What is the format of statement of profit or loss? Sales revenue minus cost of goods sold is equal to gross profit. Minus admin and selling expenses is equal to profit before interest and tax. Is it? That profit before interest and tax is known as an operating profit. So sales revenue minus cost of goods sold minus admin and selling expenses is equal to profit before interest and tax. This operating profit is also known as PBIT. Now, what is the formula of the operating profit margin? This is operating profit or profit from operations divided by sales revenue multiplied by 100. Now over here, we try to find the relationship between the operating profit and the sales revenue of the organization. Where in the case of gross profit margin, we were only having our focus on the increase or decrease in the sales revenue and the cost of goods sold. In operating profit margin, our focus will be more wider. We are going to have a look at the indirect expenses of the organization as well. Cost of goods sold are the direct expenses, whereas admin and selling expenses are indirect expenses. Yes.
Is PBIT and EBIT set?
PBIT and? PBIT and?
EBIT.
EBIT. Earnings before, yes, earnings before interest.
But shouldn't then there be minus operating costs as well?
Operating minus what?
Operating costs.
Yes, these are operating costs. Administration and selling expenses are operating costs. These are indirect expenses of the organization. Okay. Now, where our focus in the gross profit margin has only been on the control of the direct expenses, in the case of the operating profit margin, our focus will be more wider and we are going to focus on the control of the indirect expenses as well. It can happen the organization is having a gross profit, but later it is having an operating loss. If this is the situation, it means that the organization was having a good control over to its direct expenses, but due to some reasons, its indirect expenses have increased. That is why its gross profit is now converted into the operating loss. Why the gross profit could be converted to the operating loss? Because the indirect expenses are more than the gross profit. And this could be due to some fixed costs of the organization or due to some variable costs of the organization as well. Is it? So both the costs have to be looked into detail, that what has been the primary reason behind the increase or decrease in the operating profit. If the organization's operating profit is increasing over the passage of time, its operating profit margin will also increase. Moreover, the operating profit has to increase in a higher proportion than an increase in the sales revenue. Only then its operating profit margin is going to increase over the passage of time. If your numerator and denominator are same, it means that the position will be constant. What are the results which you are going to get? What are the results which you are going to get? If your numerator and denominator are same. 10 divided by 10 into 100 divided by
100 divided by 100.
100 divided by 100. So what are the results?
Same one.
It means that if your numerator and denominator, the proportion of the profit from operations is the same as the increase or decrease in the sales revenue, your results are going to remain constant with no increase or decrease. And your profit from the operations should have to increase at a higher pace, at a higher proportion, as compared to the increase in the sales revenue if you want to see the increase in your operating profit margin over the passage of time. And it would only be possible if the organization is having a capacity to decrease or to control its indirect costs in a good manner. So they say that operating profit margin is calculated as profit from operations divided by sales revenue multiplied by 100. In the exams, they can use either name. They can give it as profit from operations or earnings before interest and tax or profit before interest and tax or operating profit simply. So an alternative to operating profit margin is to calculate net profit margin using either profit for the year or profit before tax as a numerator. Students, you can either use, instead of operating profit margin, you can use net profit margin as well, in which case the formula will become profit after tax, that is the net profit for the year, divided by sales revenue multiplied by 100. Or you can use profit before tax as well. So the formula will be profit before tax divided by sales revenue multiplied by 100. So in that case, from the operating profit, you just have to deduct finance costs. From operating profit, when you do deduct finance cost, what do you get? You get profit before tax. And from profit before tax, then you deduct tax, you get profit after tax, which is net profit for the year. So either of the ratios can be used by you, because in the examination, they will not be telling you that which ratios you have to use in order to calculate the performance. Sometimes they will be telling you about the ratios, that these ratios you have to use in order to analyze the performance. Sometimes they will just be telling you to calculate the performance, to analyze the performance of the organization. Then it's your liberty which ratios you want to use. So they say any changes in the operating profit margin should be considered further. Are the changes in line with the changes in the gross profit margin? If the changes in the operating profit margin are the same as the changes in the gross profit margin, it means that the company is having a similar type of the control over to its direct expenses and to the indirect expenses as well. Are the changes are in line with the changes in the sales revenue? As many costs are fixed, they need not necessarily increase or decrease proportionately with a change in revenue. If more of the costs in the indirect expenses are fixed, can you control them? Are they having any relationship with the increase or decrease in the sales revenue? What are the variable costs? What is the behavior of the variable costs?
The company can control.
The company can control. The variable costs do increase in total with the change in the activity. The total variable costs are going to change with the increase in the level of activity. The more the level of activity, the total variable costs are going to increase, whereas per unit variable costs remain constant. And what is the behavior of the fixed costs? The total fixed costs are going to remain constant, whereas per unit fixed cost decrease with the level of activity. Per unit fixed cost decrease with the level of activity. Per unit variable cost remains constant. Total fixed cost remain constant. Total variable cost increase with the level of activity, and that level of activity could be your sales revenue or could be any other level of activity. So if in the indirect costs, the more costs are fixed one, the organization will not be having any control over them because they are not increasing or decreasing due to the change in the level of activity. They are the committed costs of the organization, which are going to incur even if the sales revenue is going to increase, or it is going to decrease, or it will be remaining constant. The fixed costs are not going to have any effect. So it means that if the operating profit margin is decreasing, it is because maybe the company has taken a new loan, or maybe the company has putting more investment into its marketing or advertising expenses, or if the organization has hired new employees to whom they are giving extra salaries. So it means that the company is increasing its variable cost. That is why the company's operating profit margin is decreasing. Then the reason can be, look at the individual categories: administration, distribution expenses, which can be marketing expenses, which can be wages or salaries, which can be commissions, which can be rents, etc. So you have to look at the individual components as well, which are going to bring increase or decrease in the operating profit margin. If your operating profit margin is okay, is reasonable as per the industrial averages, it's well and good. If it is not reasonably the same as per your industrial averages, then obviously the accountants have to look into the detail, and the control has to be exerted then. Another ratio which can be used in the ratio analysis for performance is return on capital employed. Students, what is return on capital employed? Return on capital employed is, again, profit from operations divided by capital employed. What is the formula of return on capital employed? Profit before interest and tax divided by capital employed. In this case also, the profit which you are using can be profit before interest and tax, profit after interest and tax, that is profit, net profit of the year, or it can be profit before tax. It's your choice. Whichever you want, you can. But fundamentally, the formula which is being used and discussed in return on capital employed is profit before interest and tax divided by capital employed. Now, what is capital employed? As its name is suggesting, that capital employed is the amount of capital which is being invested in the organization, which is being employed in the organization. Is it? Now come to the accounting equation again. What is an accounting equation? Assets is equal to liabilities plus equity. Is it? What is an accounting equation? Assets is equal to liabilities plus equity. This is capital employed. Is it? What is the formula of the capital employed, which you used to learn all the times? It is long-term liabilities plus equity of the organization. How does the company invest in its assets? Assets are the resources of the organization. They have to be purchased. They have to be purchased so that they can be used in the organization to generate revenue. But who is going to fund those assets? We need some money in order to get those assets as well. Who is going to fund those assets? Either we are taking the money from the third parties to invest in the assets, or we are taking the money from the investors to fund the assets of the organization. If the organization is taking the help of the third parties to invest in the resources, say for example, the bank, the relatives, the friends, family, these are the third parties from whom we are going to take a loan as a liability so that we can fund our assets. And the obligations towards the shareholders of the company is known as equity. So if the company is taking the funds from the shareholders of the company so that it can fund into the assets of the company, it is equity. So what is capital employed? The total capital which is going to be used in the organization to run the operations of the company is known as a capital employed. And it is the sum of long-term liabilities and equity of the company.
Total assets minus liability.
Sorry?
Total assets minus liability.
That is also a capital employed. I am telling you. We say that capital employed is equal to long-term liabilities plus equity. We are not taking short-term liabilities over here. Now, we also say that capital employed is equal to total assets. Let me just read it, write it in. Total assets minus current liabilities. If you are going to deduct the current liabilities out of the total assets, what is the remaining? Long-term liabilities and equity. Is it? What is your accounting equation? Assets is equal to liabilities plus equity. Assets is equal to long-term liabilities plus short-term liabilities plus equity. Is it? If you do deduct from assets, if you are deducting short-term liabilities, current liabilities, short-term liabilities are current liabilities. What is remaining? Long-term liabilities plus equity. Getting my point? Yes, Ali. Rearrange this equation. This equation, assets is equal to long-term liabilities plus short-term liabilities plus equity. So assets minus current liabilities, short-term liabilities is equal to long-term liabilities plus equity. Is it? If you are going to rearrange this equation, you are going to get this. So this is capital employed, long-term liabilities plus equity is capital employed. So that is why capital employed can be long-term liabilities plus equity, or it can be total assets minus current liabilities. In both the ways, you can calculate the capital employed, because you are funding your total assets by using the either you are taking the help of the third party, or you are taking the help of the shareholders in order to fund your assets. So your basic accounting is based upon this accounting equation, and your financial management will also be based upon this concept. Got it? Yes, Ali, are you clear now? So they say return on capital employed is equal to profit divided by capital employed multiplied by 100%. This shows the ability of the entity to turn its long-term financing into profit. Okay, what is the particular objective to calculate return on capital employed? Consider it. Students, in the exam also, if you are blank about some ratio, you just forgot that what we wanted to analyze in a particular ratio, then just start focusing on its, on its words. Return on capital employed. It means that how much return the company is earning by using the capital employed in the organization. Why the capital is going to be employed in the organization? Because the organization does want to earn return. Organization does want to make profit out of it. So capital is going to be employed in order to get the returns. How efficiently the company is using its capital in order to generate profit is known as a return on capital employed.
The profitability of the company?
Yes, it's the profitability of the company. How well, look Ali, in all of the ratios in which profit is going to be used as one figure, they will be telling us the profitability of the company. They will be telling us the performance of the company. Because profitability and liquidity are not the same. Profit, in the next particular portion, we are going to discuss. So profitability is going to be analyzed in the performance ratios. So how well, how efficiently the company is using its capital in order to generate profit is known as return on capital employed. If over the passage of time it is increasing, it means that the company has been able, more efficient to use its economic resources, to use its capital employed. Otherwise, it's not. The capital employed, return on capital employed is equal to profit divided by capital employed multiplied by 100. And students, if say, for example, the more complex question doesn't come over here in P2, in SPR, this is going to be asked to you in your future. Over there, students, divisional performance could also be analyzed. If you are having a look at a certain company which is divided into divisions, over there you have to use controllable return on capital employed. Because who is having the capacity to decide the employment of the capital in the organization? The senior managers, strategic effects. Who is going to decide that this much amount of the capital has to be invested in the company? Not the divisional managers, is it? The divisional managers are primarily not going to have any capacity to decide about the capital employed. So it means that the capital employed is not in their control. So there should not be, their performance should not be judged upon certain factors which are not in their control. So over there, we do have to change a formula to a little bit, but over there, it is not examinable. So anyhow, this shows the ability of the entity to turn its long-term financing into profit. And what is long-term financing? Long-term liabilities plus equity. Profit is measured as operating profit or the profit before interest and tax, that is profit before taking account of any returns paid to the providers of the long-term finance. What are the returns paid to the providers of the long-term finance? Interest. Who are the providers of the long-term finance? Who does provide the long-term finance of the company? Either the third parties or the shareholders. The returns which you have to give to the third parties is known as interest. The returns which you have to give to your equity providers is dividend. Dividend is not deducted from the statement of profit or loss, is it? The dividend is only going to come in the statement of changes in equity. So that is why we are concerned about the return which we have to give to the providers of the long-term finance, that is interest. So this is what they are telling you, the profit before interest and taxation, that is profit before taking account of any returns paid to the providers of long-term finance. Capital employed is measured as equity plus interest bearing finance, that is long-term finance supporting the business. This usually includes all these liabilities, whether they are shown as current or non-current. Total assets less current liabilities. So either we can take assets is equal to total liabilities plus equity, or we can use as assets is equal to non-current liabilities plus equity, or assets is equal to capital employed is equal to total assets minus current liabilities. So whichever formula you want to use, you can. Students, similarly to return on capital employed, we can use the formula of the return on equity as well. If we are concerned to know that how well the equity finance is being used in the organization, then instead of doing return on capital employed, we can do return on equity as well. So return on equity formula will be profit after tax divided by equity multiplied by 100. So over here, instead of using total capital employed, we are using only the equity financing. So we are not seeing about the efficiency of the finance which is provided by the third parties, but the efficiency of the finance which is being provided by the investors. So it can be of primary importance to the investors of the organization as well, that the funds which we are providing to the organization, how well they have been consumed. So return on equity is equal to profit after tax divided by equity multiplied by 100. So it's upon your wish which ratios you want to do in order to see the analyze the performance of the company. So this can be used to show the return made for the year on the total equity in the business. Pre-tax return on equity can also be calculated using profit before tax rather than profit after tax. So again, instead of using profit after tax, you can use profit before tax as well. So now students, we are going to move on. If you are clear about these concepts. Any confusion up till here, you can ask. Malva, are you cleared? Sharifa, are you present in the class?
Yes, ma'am.
Okay, great. Okay, now students, the next performance ratio is net assets turnover. Net assets turnover, the formula is sales revenue divided by capital employed. Now, net assets turnover gives us the capacity to analyze the efficiency of the capital employed to generate sales revenue. Net assets, what is net asset? What are net assets? Total assets minus?
No, that's not.
What are net assets?
The total assets.
Yes. Total assets? Total assets are net assets? No. Assets minus liability is net asset. So what is net asset basically? It's equity. Total assets minus liability. What is remaining? It's equity. So net assets turnover, look in the denominator, you are taking capital employed. You're again taking capital employed. So turnover is basically sales revenue. So sales revenue divided by capital employed is equal to times per annum. The ratio, the answer to this ratio will be in times. How many times the sales revenue is more than the capital employed of the company will be analyzed by using the net assets turnover. If the answer to this ratio is more than 1, it means that the sales revenue is more than the capital employed. If, say, for example, the answer to this ratio is 1 time, it means that sales revenue is exactly equal to the capital employed. The company is generating the same amount of the sales revenue as the amount of the capital employed. If the answer is 1.2, it means that sales revenue is 20% more than the capital employed of the company. So it should be basically more, because the organization should be earning more sales revenue in regards to the capital which is being employed in the company. So they say capital employed can be calculated as equity plus interest bearing debt. Capital employed can be calculated as equity plus interest bearing debt. So obviously it is again equity plus liabilities. As an alternative, net assets, total assets minus total liabilities could also be used. So if you are deducting total liabilities from the total assets, you will be remaining only with the equity. So instead of taking long-term liabilities and current liabilities both into view, you can take only equity into the view also. It measures the management's efficiency in generating revenue from the net assets at its disposal. The higher the assets turnover, the greater the efficiency. So obviously, if the answer to your ratio is more than 1, the organization's management will seem to be more efficient. Note that this can be further subdivided into non-current assets turnover by making non-current assets as the denominator, working capital turnover by making net current assets the denominator. So you can use different types of the denominators as well to change your ratios. You can make it non-current assets turnover, sales revenue divided by non-current assets, which will be telling you the efficiency of the non-current assets to generate sales revenue. Or you can use working capital turnover ratio as well. So instead of taking capital employed, you are going to take only working capital. What is working capital? Current assets minus current liabilities. So working capital turnover by making net current assets the denominator. What are net current assets? Current assets minus current liabilities. So again, it's at your disposal. Now, sometimes in the examination, the multiple choice question, this slide can be asked to you. That is a relationship between ratios. They can be giving you any of the 3 to 4 figures out of this formula, and they will be asking you to calculate the rest. So you should also know that profit margin multiplied by assets turnover is equal to the return on capital employed. If you do take a product of profit margin and asset turnover, you will be getting a return on capital employed. What is return on capital employed? Profit before interest and tax divided by capital employed. What is asset turnover? Sales revenue divided by capital employed. What is profit margin? Operating profit margin, PBIT divided by sales revenue. So basically, the product of these two is return on capital employed. How? Sales revenue will be deducted by the sales revenue. Both of these are going to be deducted. What is remaining? Profit before interest and tax divided by capital. So that is why we do say that return on capital employed is equal to the profit margin multiplied by assets turnover. This could be asked to you in the examination. So they say profit margin is often seen as an indication of the quality of the products or services supplied. Top of range products usually have higher margin. Asset turnover is usually seen as the measure of how intensively the assets are worked. So profit margin is going to indicate the performance of the company, how well the company is generating the sales revenue, what is the relationship of the gross profit or the operating profit to the sales revenue. Is the company earning its profit with the same pace as it is earning the revenue? Students, if the sales revenue is increasing, but the gross profit of the company is decreasing, what does that mean? The company has been efficient to make the sales, but the management of the company is not efficient to control its direct costs. So basically, the profit margins is going to look at the capacity of the company in order to increase sales revenue and to decrease its cost or to control its cost. Whereas asset turnover will be having a capacity to analyze the efficiency of the management to generate revenue. How efficient the company has been to convert its capital employed into the profit of the company. So that is why they say profit margin is often seen as an indication of the quality of the products or services supplied, because the more qualitative the products are, they will be having the capacity to generate more revenue. And assets turnover is often seen as a measure of how intensively the assets are worked. A trade-off may exist between margin and asset turnover. Low margin business, food retailers usually have a high asset turnover. Students, why is it so? Low margin businesses, that is food retailers, the food retailers are having a lesser profit margin because they are going to have a lot of competition. The sales revenue generated by all of them is more or less the same. So low profit margin businesses usually have a high asset turnover. Why is it so? How are you going to get the high asset turnover? In high asset turnover, your sales are going to increase in high asset turnover. The sales are going to be in a greater proportion as compared to the capital employed. This is the net assets turnover. So those businesses which are having low margin business, which are having low profit margin, will be having high asset turnover. Why is it so?
Because they won't have high capital employed.
They will be having high capital employed. They will be having low capital employed.
Yes.
I asked that those businesses who are having a low profit margin will be having a high asset turnover. Why is it so? Do you remember the concept of depreciation and amortization? It is going to be increased when the organization is using older assets. Is it? When the organization is going to use the old assets, those organizations which are highly machine intensive, their assets are going to become old with the passage of time. The higher rate of depreciation is going to be deducted out of those. When the higher rate of depreciation is going to be deducted, the profit is going to decrease. Is it? When the profit is going to decrease, the profit margin is going to decrease. So when the organizations are having a high asset turnover, because the value of the asset is going to decrease, the more the depreciation, the value of the asset is going to decrease. So the asset turnover ratio is going to become high. Sales revenue is more than the amount of the capital employed, more than the amount of the net assets. Is it? The asset turnover ratio is going to increase, whereas your profit margin is going to decrease. So that is why we say, in order to window dress the performance and create the accounting for the company, managers do these tasks. When the organizations are not investing in the assets, their assets position is going to deteriorate with the passage of time. Their net asset turnover ratio is going to be very much good. But the reason behind it, it's very worse. Why their net asset turnover is looking good? Because their assets are very old. Is it? The lesser the value of the denominator, the higher the ratio is going to be there. Because your numerator is increasing with the higher capacity as compared to the value of the assets, to the value of the denominator. So that is why those businesses who are having low margin will be having a high asset turnover, because they are low margin, their sales revenue is more or less going to be the constant one. But their cost, the indirect cost and the direct cost also is going to increase. So that is why their profit is going to be lesser. So low margin businesses will be having a high asset turnover ratio. Capital intensive manufacturing industries usually have relatively low asset turnover but higher margins. So the opposite reason is behind there. Capital intensive manufacturing industries, that is electric equipment manufacturers, obviously they do need updated technology. So they will be investing more into the technology, more into the assets. Their assets will be newer. The assets will be new, less depreciation will be charged on those. Usually on the electrical equipments, we do use reducing balance method of depreciation according to the pattern of their usage. So reducing balance method of depreciation is going to be used. The older the assets are, the higher depreciation is going to be charged on them. Is it? So that is why those with the higher capital, with the higher margin will be having lesser net asset turnover. Those with the low margins will be having higher net asset turnover. Those will be with the lesser asset turnover will be having the higher business margins. So that is the difference. So in short, return on capital employed is equal to profit margin multiplied by asset turn. Now students, we are going to have a break. We are not going to have a lot of break, only 10 to 15 minutes break we are going to have, and then we are going to resume the lecture. Okay? And we are going to learn about the position ratios. Okay, my online students?
Yes, ma'am.
Shall we take a break? See you after the break.
Ma'am.
Oh. Now, students, we are going to start discussing about the next portion of the ratios, that is position ratios. In order to analyze the position of a company at one particular date, we do use these ratios. Under these ratios, we have certain kinds of the ratios like current ratio, quick ratio, inventory turnover period, payables payment period, and then we have receivables collection period as well. So in position ratios, the values which we are going to undertake are from statement of financial position, which is also known as balance sheet. The first ratio which has to be discussed under this is current ratio. The answer to these ratios will not be in the form of percentages. We will either be getting the answer in the form of times, or we are going to get the answers in the form of days. So usually the answer to the ratios under position is not going to be in the percentage form. The first ratio which we are going to discuss is current ratio. Current ratio is current assets over current liabilities. How many times the current assets of the company are present in proportion to the current liabilities? How much more current assets or how much less current assets the company is having in regards to the current liabilities, in proportion to the current liabilities or in comparison to the current liabilities. If the answer to this ratio is more than 1, it means that the company is in a secure position. The company, if say for example, the answer to this ratio is 1.2, it means that the company is having 20% more current assets than the current liabilities. So if the current assets are more than the current liabilities, it means that whenever the short-term liabilities of the company are going to become due, the company will be easily able to pay them off. The company will be able to fulfill its short-term liabilities if the answer to this ratio is more than 1. So normally we do say that the current ratio of 1.2 is favorable. Not lesser than that, not more than that. If you say for example, that the current ratio is 2, it means that the organization is having double current assets than the current liabilities. Am I right? The current assets are double than the current liabilities, which is not a good thing, which is again not a favorable thing. Why? Because the organization is having slow moving inventory. When the inventory is going to be increased, current assets will be higher. Inventory is one of the current assets. If the organization is not able to sell its inventory, the current assets will be more. Will look the favorable ones, but actually it is not a favorable condition. So we have normally set a particular standard that the current ratio of 1.2 is a favorable one. If it's lesser than that, it means that the organization will be facing difficulties in paying off its liabilities. If it's more than that, it means that the company is having slow moving inventory or irrecoverable receivables as well. If the receivables are more, what does that mean? It means that the organization is not able to collect them in the timely period. So getting the more current assets is favorable, but having a lot of current assets is not a good thing, because it can suggest us that the organizational management is poor in certain circumstances. So current ratio, current assets divided by current liabilities, it is also known as working capital ratio, because working capital is current assets minus current liabilities. So current assets divided by current liabilities is known as a current ratio or the working capital ratio. So we are going to get the answer to this ratio in times. Current assets divided by current liabilities, ratio 1. It means that we are going to get the answer in the ratio form. If it's 1, it means that current assets are equal to the current liabilities. If it's 0.9, it means that current assets are 10% lesser than the current liabilities. And it means that whenever the current liabilities of the company are going to fall due, the organization will be having difficulties to pay them off. If the organization has to pay the payables, and if it's not having cash, it means that the organization is going to suffer. Position ratios tells us about the liquidity position of the company. Performance ratios tell us about the performance of a company, about the profitability of the company. Is it? Position ratios tell us about the liquidity of the company. Students, when we have discussed about performance ratios, they tell us about the profitability of the company. The position ratios primarily tell us about the liquidity of the company. Is it? There must be a balance between profitability and liquidity. Profitability and liquidity are not the same. It never means that if the company is profitable, it is liquid also. Liquidity means that the company is having enough cash to pay off its liability. The organizations in the long run face difficulties in having a balance between liquidity and profitability. When you will be becoming the management accountants or finance managers, you will be facing this difficulty as well. If the company is having more profitability, it means that the company is over trading. It's over trading. Why? Because we do calculate the profit on the basis of accruals basis of accounting. When we are writing the sales revenue, it is having credit and cash sales both in it. Is it? Credit sales, we have not received the cash, but still we are using it in order to calculate the profit. It means that if the company is more profitable, it does not mean that the company is always liquid enough to pay off its liabilities when they are falling due. The profitability of the company does not ensure its going concern. Even if the company is highly profitable, it can collapse in a while. Because profitability never going to make the company secure. It is liquidity which is going to make the company more secure. So that is why from one perspective, users have to see the profitability of the company. From the other perspective, they have to see that whether the company is liquid enough in order to pay off its liabilities when they are falling due. When you have your payables, you cannot tell them that take our profit to fulfill the obligations. We are not going to say that. They need cash. They need liquid assets to get satisfied, is it? So that is why there should be a balance between profitability and liquidity. If there is more profitability, the company is over trading. The company is being profitable on the cost of its cash, on the cost of its liquidity. Making the more receivables, what does that mean? If the company is having high receivables, what are you going to comment? You will become happy that the company is very profitable since it is having high receivables. It is having a lot of perspectives behind it because the company is having high receivables since it is making more sales to the credit persons, to those persons who are not paying them in the form of cash immediately at the time of transaction. And it means that the company is making the credit sales so that its sales revenue could increase. It means that receivables will be higher, but receivables does not ensure the cash. Later, if they become bad, the bad debts will be there, irrecoverable debts will be there. The company will be running into losses. So overtrading means that the company is trading more, but having lesser cash behind. So there should be a balance between profitability and liquidity, because on the other hand, if say, for example, on the sake of cash, the company see that, say, for example, they are not making the sales because they do need cash. They are not making the credit sales because they do need cash. It means that the profitability is going to deteriorate. The customers will not be attracted towards the company. And in the long run, cash is also going to reduce. So it means that the company should be having a balance between profitability and liquidity. It should not be over trading as well as under trading also. So current ratio, current assets to current liabilities, organizations must be having at least 1.2 current ratio to ensure security, to ensure safety, so that whenever its short-term debts are going to fall due, it has to pay them without any difficulty. If it's more than 1.2, even then it's not good. If it is lesser than 1, even then it is not good. So the current ratio measures the adequacy of current assets to meet the liabilities as they fall due. And please keep in mind the rule of the finance, the short-term liabilities have to be fulfilled using current assets. Long-term liabilities have to be fulfilled using non-current assets. A high or increasing figure may appear safe, but should be regarded with suspicion as it may be due to high levels of inventory and receivables. Check working capital management ratios. So if you are having a very good current ratio, it is not always a good thing. If you are having more than 1.2 current ratio, it can mean that you are having a slow-moving inventory. You are having high levels of inventory which the organization is not able to convert into turnover. That is why it is seeming to be as a high ratio of the current assets. On the other hand, it can be receivables which are not being converted into the cash. On the other hand, high cash levels could be put to a better use. If the organization is not investing its cash anywhere, it means that it is wasting its resources. Cash is a resource which, if it is not used anywhere, at least has to be invested somewhere so that it can try earning interest on it. So it should not be vacant. So instead of having high levels of cash, it should be put to a better use. That is by investing in non-current assets. Current ratio is not always good. It's especially not good to analyze the position of the companies which are having a lot of inventories in them. Obviously, those organizations who are having slow-moving inventory or who are not efficient to convert quickly its inventory to the sales, for those, this current ratio is not usable, is not going to be an advantageous one. So for those organizations which are struggling with selling the inventory, for those, quick ratio is suggestible, advisable. Quick ratio is just an extension of the current ratio. Quick ratio is also known as asset test ratio. Current assets minus inventory divided by current liabilities is known as quick ratio or asset test ratio. From the current assets, when we do deduct inventory, it means that we are having a more wider view that after deducting inventory, how much current assets are remaining for the company. And if then they are more than the current liabilities, then the company is in a secure position. Say, for example, if the organization is having a current assets of 1,000, And if the organization is having an inventory of, say for example, 800. And if the organization is having a current liabilities of 700, what would be the current ratio? Current assets over current liabilities, 1000 divided by 700. It would be 0.7. Is it? And what would be the quick ratio? Quick ratio, current assets minus inventory divided by current liabilities. It will be 200 divided by 700. It will be more worse. It will be more worse, is it? It means that current ratio can give us an unfavorable analysis. So that is why for those organizations who are having high levels of inventory or are having slow moving inventory, we have to use quick ratio instead of asset test ratio to get the more clearer view. Maybe your current ratio is looking favorable because of the high amounts of inventory. After deducting inventory, we are left with only 200 current assets, which are very lesser. Is it? So that is why you have to be careful. Sorry, students, it will be 1.3. Is it? Is it? So it is 1.3. It is looking favorable, but over here it will be lesser than 1. It means that it will be deteriorate. Yes, dear? 0.3. It will be lesser. Okay. Then students, they say quick ratio, also known as the liquidity or asset test ratio. Quick ratio is equal to current assets minus inventory divided by current liabilities. The quick ratio is also known as the asset test ratio because by eliminating inventory from the current assets, it provides the asset test of whether the company has sufficient liquid resources, receivables and cash to settle its liabilities, as well as analyzing how safe a business is. By looking at the current and quick ratio, it is important to look at why the ratios have moved by considering working capital in more depth. So when we are going to calculate the quick ratio or the current ratio, it is not enough. We have to see for the underlying reasons, that what are the reasons behind if your quick ratio is looking favorable and if your current asset ratio is not looking favorable, what is the reason behind that? So you have to look for that also. Now students, the next position ratio is inventory turnover period. Inventory is being purchased for the purpose of resale. What is an inventory? All the assets which are purchased for the purpose of resale are known as inventories. Inventories are current assets. Current assets are normally purchased for the purpose of resale. So inventory, how efficiently the company is able to convert its inventory into the sales is known as an inventory turnover period. In how many days the company converts its inventory into the sales is known as inventory turnover period. So if it is more and more with the passage of time, if it's increasing, it means that the company is becoming less efficient to sell its inventory. And with the passage of time, inventory is going to become obsolete or outdated, or if it's perishable, then obviously a more headache is going to be there. So inventory turnover period is calculated as inventory divided by cost of sales into 365. So the answer to this ratio will be in the form of days, because it tells us the number of days in which the inventory is converted into the sales revenue. How many days the company is normally taking to convert its inventory to the sales revenue is known as inventory turnover period. Instead of inventory turnover period, we can calculate the inventory turnover ratio as well, in which the formula will become cost of sales divided by inventories is equal to times per annum. It tells us that how many times in a year the inventory is converted into the sales. If the answer to this ratio is 3, it means that 3 times in a year, 3 times per annum, the inventory is being converted into the sales revenue. So we can see the inventory turnover from 2 perspectives. How many days the company is normally taking to convert its inventory into sales is inventory turnover period. And inventory turnover ratio tells us that how many times in a year the inventory is being converted into the sales. So they say inventory turnover period is calculated as inventory divided by cost of sales multiplied by 365, An alternative is to express the inventory turnover period as a number of times per annum. So cost of sales divided by inventory is equal to times per annum. Students, you have to memorize these formulas. They say an increasing number of days or a diminishing multiple implies that the inventory is turning over less quickly, which is regarded as a bad sign, as it may include lack of demand for the goods, poor inventory control, an increase in the cost, storage, obsolescence, insurance damage. If the organization is having lesser inventory turnover period, it means that the organization is not having the capacity to convert its inventory to the sales more. So it means that the reason behind it, that the lack of the demand of the goods is there, the company's goods are no more demanded, that is why they are still in inventory. It can be due to the poor inventory control as well. Your organization's management is not efficient to convert the inventory to the sales. And it can bring the disadvantages as increase to the cost. The more the inventory, the more the storage cost. The more the disadvantage regarding to obsolescence will be there, and higher insurance charges and higher chances of the damages will be there. And however, it may not necessarily be bad where management are buying inventory in large quantities to take advantage of trade discounts. Sometimes you have to analyze also that maybe the organization is having a higher inventory levels to get bulk discounts. Trade discounts are the types of the discounts which are going to be getting as a deduction in the list price of the goods. So when you are purchasing in bulk, you are going to get the trade discounts. So maybe the inventory levels are higher because the company is trying to take the advantage of the economies of scale. Economies of scale is again a jargon, which means that by increasing the scale, we are going to get the economies. We are going to get the advantages. So the more the levels of the inventory are going to be purchased, the bulk discounts can be taken. This could be one of the advantages while the organizations are having bulk inventories. And increasing inventory levels to avoid stock outs. Nowadays, students, the organizations are not going to have a lot of inventory because we are in such an era where TQM, total quality management, just-in-time inventory levels, all the Japanese techniques are in place. So the manufacturing organizations are normally not having higher inventory levels. Why? Because the more the inventory levels, the extra costs are going to be there. Am I right? So that is why zero inventory levels are normally be there in the organizations. But some organizations are having such type of the activities where there is always a disadvantage of the stock outs. The manufacturing is in place and the bottleneck does come. Bottleneck is a situation in which the manufacturing is going to be stopped because there is no level of raw materials coming from behind. So there will be a bottleneck. So over there, increasing inventory levels could be there to avoid stock out so that the manufacturing could not be stopped at any level. So you have to see for these reasons when you are going to analyze the situation. Then the next position ratio is receivables collection fee. How well the organization is collecting its debts from the receivables is going to be told to us by receivables collection fee. How many days the organization is normally taking to take back its debts from the receivables. Receivables are the persons to whom the organization is making the sales on credit. We are making the sales to the receivables and we are not taking the cash immediately at the time of transaction, but we are being promised by the receivables that they will be paying us in the future. So how many days the organization is normally taking to collect back its debts from the receivables is known as receivables collection fee. So the formula receivable collection period is trade receivables divided by credit sales multiplied by 365. Students, if you are not being given the credit sales in the examination separately, you can take the total value of the sales as well. And over here, in inventory turnover period also, you are normally going to take average inventory. The formula is average inventory divided by cost of sales. Average inventory is opening inventory plus closing inventory divided by 2. Okay, but if average inventory is not going to be calculated because the information is limited, then you can use closing inventory. Then you will be using closing inventory. Similarly, in the case of the receivables collection period, if credit sales are not being given, you can use the total sales as well. Okay, the formula for the receivables collection period is trade receivables divided by credit sales multiplied by 365. So it will be telling you that how many days the organization is normally taking to collect back its debts from the receivables. The more the days are, the lesser credit control department efficiency is there. What is the credit control department? The department whose objective is to control the credit of the organization, to collect back the debts which are due from the receivables. So if the credit control department is not efficient, it means that the receivable days are going to increase. Moreover, if the receivable days are more, it may happen because the company is trying to increase its sales. Because the customers will be more attracted towards the organization if they are having this capacity that they will be getting the purchases on credit. They could purchase on the basis of the credit. So this could also be the reason. So they say this is normally expressed as the number of days trade receivables divided by credit sales multiplied by 365. If the figure for the credit sales is not available, revenue should be used, and revenue is total sales. The collection period should be compared with the stated credit policy. Sometimes the credit policy tells us the number of days which normally the company should be giving to its receivables for collecting the debts. Say, for example, the receivables can pay within 10 days of the sales. So if it is matching, if the credit sales days are matching the credit policy, then it's fine. If it's taking more than that, then it's going to be unfavorable. And previous period figures. From the previous period also, we have to compare the receivable collection days. If it's increasing from the previous days, it means that either the credit sales are increasing, or on the other hand, the trade receivables are decreasing. Okay. So increasing accounts receivable collection period is usually a bad sign, suggesting lack of proper credit control, which may lead to irrecoverable debts. Whenever we are having the receivables for a long period of time, there are higher chances that they will be converted into the irrecoverable debts. And once the debts are going to be converted into the irrecoverable ones, it means that profitability of the company is also going to decrease. What is the accounting entry for irrecoverable debts?
Irrecoverable expense.
Sorry, debit.
Irrecoverable expense.
Excellent. And credit receivables. Very good. So it means that irrecoverable debts have to be written as the indirect expense in our SOPL. So the more the irrecoverable debts, our profitability is also going to decrease. So it will be affecting in the long term both to our liquidity as well as our profitability. So it may, however, be due to the trade policy to attract more trade. So it can be receivables could be more because the company does want to make more trade. So the customers could find the organization more favorable since it is giving the sales on the credit as well. Or on the other hand, a major new customer being allowed different terms. Falling receivables days is usually a good sign, though it could indicate that the company is suffering a cash shortage. So falling receivables, what is the meaning of the falling receivables? That the receivables are falling. Is it? Receivables are going to fall and the company is going to have more cash. Normally it means that. Is it? So falling receivables is usually a good sign, though it could indicate that the company is suffering a cash shortage. Then why the company is going to suffer a cash shortage if the receivables are reducing? If the receivables are reducing because they are becoming irrecoverable debts, the company will not be having a cash behind it. Even though the receivables are reducing, but because they are reducing because of them becoming irrecoverable, then the company will not be having a cash behind it. If they are reducing because the company has recovered the cash out of them, then company will be having more cash behind it. Next position ratio is the payable payments period. So contrary to the receivables collection period, the company is going to analyze the payables payment period as well. Payables payment period tells us that how many days the company is normally taking to pay back its payables. Payables are the creditors of the company. These are the persons or the parties from whom the company has purchased something on credit. If the company is purchasing something right now and is not immediately paying the amount in the form of the cash, it is known as the payables going to arise. Is it? So the credit purchases are being made from the payables. So payables are all those persons from whom the company is purchasing something on credit. How many days the company is normally taking to pay back its payables is known as the payables payment period. Students, normally, when you will be becoming an accountant, you will also be facing the same condition. The accountants are normally stressed by the management to delay the payments. In the small companies here in UAE also, you may have seen, you may have observed that they are delaying the salaries. They are delaying the payments. Why? Because they do want to collect the working capital for day-to-day expenses. If their payables are going to be delayed, it means that the amount which they could have paid to the payables can be used in the organization now as a working capital. So instead of paying to the payables, instead of paying to the persons to whom the organizations are having the obligations, they can use that cash instead. So they could be delaying the payments, but in the long run, it will be affecting the goodwill of the company. It will be deteriorating the repute of the company in the market. Stakeholders are not going to be satisfied and they are going to ruin or tarnish the image of the company in the market. So you might have seen that the companies who are running on the large scale are not delaying the payments. Is it? They are not delaying the payments. The companies who are running on a short scale, they do delay the payments because they are still struggling. The more they delay the payments, the more working capital they are going to get. The long concerns, they are large concerns, they are not having these kinds of problems. So that is why they are not going to do this. However, payables payment period, this is usually expressed as trade payables divided by credit purchases multiplied by 365. How many days the company is normally taking in order to pay back its payables will be told to us by the payables payment period. This represents the credit period taken by the company from its suppliers. The ratio is always compared to the previous years. A long credit period may be good as it represents a source of free finance. So if the company is having a lot of payable payments period, it will be acting as a free finance. The company wants to enjoy a free finance. That is why it will be delaying the payments to the payables. A long credit period may indicate that the company is unable to pay more quickly because of liquidity problems. The other reason for the company not paying the payables in time is that the company is having the liquidity issues. The company is not having the cash. The company may seem profitable. The company seems to be a profitable one, but may not be having enough cash to pay its liabilities when they are falling due. So the other reasons for the large amount of the payables payment period could be that the company is having a liquidity issue. If the credit period is long, the company may develop a poor reputation as a slow payer and may not be able to find new suppliers. Only for a certain time limit, your suppliers are going to, what we can say, afford you. Otherwise, what they are going to do, they will not be making new contracts with you. They are not going to make any kind of new contracts with you because your image is being tarnished. You are not paying in time. Existing suppliers may decide to discontinue supplies, and the company may be losing out on worthwhile prompt payment discounts. The cash discounts, the settlement discounts are going to be lost by the company in that case. What are settlement discounts? What are settlement discounts? Cash discounts, very good. The other name of the settlement discounts is a cash discount. What is a cash discount? Very good, excellent. A discount which is going to be offered only when the creditor is being paid within a promised time limit. Say, for example, the 10 days are the promised credit time period. Within 10 days, if making a payment, then certain other discount is going to be offered. If at 11 days it is being paid, then this discount is not going to be offered. So when the organization is not paying in time, it would lose its prompt payment discounts, that is settlement discount or cash discounts. Now students, another ratio in order to calculate the position, in order to analyze the position of the company is working capital cycle. This is not a ratio basically. This is an equation, working capital cycle. Working capital cycle is equal to inventory turnover period plus receivables collection period minus payables payment period. In organization, the money cycle, the cash cycle is going to be continued, students. The time period which the organization is taking to convert its inventory into the sales plus receivables collection period, the time period which it is taking to receive the money from its receivables minus payables payment period, the time period which it is taking to pay back its payables is going to be working capital cycle. This is a time period in which the company's cash will be returned to it, will be coming back to it. Inventory turnover period, the time period in which the inventory is going to be converted into the sales. It means that when the inventory is going to be converted into the sales, the cash, the liquid position of the company is going to increase, or the profitability is going to increase. Receivable collection period, the time period in which the receivables are paying back the company. Minus payables payment period, it means that the time period which the company is taking to pay back its payables. Ultimately, the figure which we are getting is a time period in which the company is getting its cash back. The company is fixing its cash to somewhere by making the receivables or by purchasing the inventory. After taking the payments back, the cash is going to be returned back to the company. Then the working capital cycle shows the average length of the time between paying the production cost and receiving the cash returns from the inventory. So the working capital cycle is becoming more and more and more. It is not favorable one because the company's cash is stuck for a larger amount of time period. It is not good for the company. It is again going to deteriorate the position of the company. In order to calculate the working capital cycle, you have to use three ratios: inventory turnover period, receivables collection period, and payables payment period. So you have to be clear about the formula of all these three. So what is the formula of the inventory turnover period? Inventory divided by cost of sales multiplied by 365. Receivables collection period? Very good. Trade receivables divided by credit sales multiplied by 365. And payables payment period? Trade payables divided by credit purchases multiplied by 365. Very good. Let's move to the next slide now. Students, we are going to do one example that is on page number 589. Let's start with this. I will be opening the book. I will be telling you, just give me a while. Here it is, students. Okay, in Ramzan, the timings are going to be reduced by 1 hour. The timings are going to be reduced by 1 hour. So instead of taking 3 hours class, we are going to have 2 hours class. Okay, so now you tell me which time is more suitable for you. 10 o'clock to 12 o'clock or 11 o'clock to 1 o'clock? 1 hour is going to be reduced. 10 o'clock to 12 o'clock or 11 o'clock to 1 o'clock? Sorry? None of them, yeah. So 10 o'clock? 2 o'clock? If you are going to ask me, I will say after iftar. Okay. Because I'm not sure even in 2 hours I would be able to speak or not. It's very difficult for me to do fasting, to be very honest. Everyone wants this, but university is not going to allow us. So anyhow, what they have suggested me is to take the first slot from 10 o'clock to 12 o'clock. What do you suggest? 11 o'clock? 10 o'clock?
1 to 3. 1 to 3. That's good.
Only 2 slots are available, not the third one.
And then making it 3 slots.
Okay. Okay, we will see. Anyhow, the timings are going to be reduced by 1. Now, students, we are going to do this question, but I'm not going to do this question. You yourself have to do this question. The requirement of the question is calculate the following ratios for ocean, motors, and briefly comment upon what they indicate. So what you have to calculate, you have to calculate 3 ratios under profitability. No, sorry, 4 ratios. 4 ratios you have to calculate under profitability. Gross profit margin. The formula of the gross profit margin is gross profit divided by sales revenue multiplied by 100. Then you have operating profit margin. It is profit before interest and tax divided by sales revenue multiplied by 100. Then we have return on capital employed. The formula is operating profit divided by capital employed multiplied by 100. Then we have net assets turnover. The formula is sales revenue divided by capital employed or net assets. You are going to get the answer for in times for this ratio. Then we have liquidity and working capital ratios. Current ratio, the formula is current assets divided by current liabilities. We have quick ratio, current assets minus inventory. Current asset minus inventory is known as quick assets, okay, divided by current liabilities. Then we have inventory collection period. Sorry, inventory. Yes, inventory collection period. It is basically inventory turnover period. By mistake, they have written as inventory collection period. Inventory turnover period is equal to average inventory divided by cost of sales multiplied by 365. Then we have accounts receivable collection period. The formula is trade receivables divided by credit sales multiplied by 365. And then we have payables payment period as well. What is the formula of the payables payment period? Accounts payable payment period. Trade payables divided by credit purchases multiplied by 365. Now students start calculating the ratios. Gross profit margin. Here are the financial statements. Statements of the financial position and statement of profit or loss for ocean motors are set out below. The first portion is to calculate the performance ratios, which you are going to calculate from the statement of profit or loss. So see these statements. Gross profit margin, what is the gross profit? What is the gross profit? For 2002 and 2001. For 2002, how much gross profit is there? 800. Is it? Divided by how much is the sales revenue? 1500. Multiplied by 100. How much is the answer? For 2001, how much is the gross profit? 700. Sales revenue is 1000. Multiplied by 100. Tell me, 800 divided by 1500 multiplied by 100?
53.3.
How much?
53.3.
53.3%. Okay, now 700 divided by 1000? 33?
78.
Sorry?
2001, right?
No, 700 divided by 1000 multiplied by 100.
Yeah, 70.
70? Okay. Now, how are you going to comment on this?
Why do we have to calculate it?
Because it is required. See the requirement. Calculate the following ratios for ocean motors and briefly comment upon what they indicate. As you can see that your current, your gross profit margin has decreased Gross profit margin is decreasing. In 2001, it has been 70%, whereas in 2002, it has decreased to 53.3%. It is because your gross profit is increasing, but your sales revenue is increasing at the higher proportion as compared to your gross profit. It means that the company's sales revenue has increased, but the gross profit is not increasing at the greater pace, at the same pace as the sales revenue of the organization. Why? Sales revenue has been increased, the company is good, but gross profit is not increased. It means that the company's direct costs are more. Direct costs are not written over here. Yes, cost of sales, you can see. The cost of sales are more than 50% increase. More than 100% increase is there. Is it? Students? The gross profit of the company has increased, but it is increasing at a lesser proportion as compared to the increase in the sales revenue. It means that around 50% of the increase in the sales revenue is being there. But only we can say 10 to 20% increase in the gross profit margin is being seen. It means that the company was efficient to make the sales revenue, but the company was not efficient to convert its sales revenue to the gross profit. Why? Because the cost of sales are increasing at a very rapid pace. More than 100% increase in the cost of sales is there. So the company's control over the direct cost is lesser. That is why gross profit margin is deteriorating. It is just 53.3% with a decrease of 30%. 20% around 20% decrease in the gross profit margin is there. So this is how you are going to go. Then operating profit margin, operating profit divided by sales revenue. Operating profit, profit before interest and tax. This will be profit before interest and tax. Since interest is not being given, so profit before tax can be taken. That is 400 divided by sales revenue 1500 multiplied by 100. For 2001, it will be 340 divided by sales revenue 1000 multiplied by 100. So operating profit, you are going to calculate. Similarly, all the other ratios are going to be calculated during your comment. Calculate ratios one by one and tell me your answers as well.
So 2002 is 26.4.
26.4, yes.
2001 is 23.9.
23.9%. It means that it has increased. Why it has increased, students? Why it has increased? There is a small increase, we can say. Around 2 to 3% increase is there in the operating profit margin. Why is it so, students? Because you can see that the administration and distribution expenses have increased at a very lower pace. They have increased from 360 to 400, whereas sales revenue has increased from 1000 to 1500. So organization was not able to control its cost of sales, but indirect costs are being controlled. Maybe the organization is cutting the expenditure on advertisement or marketing, etc. Or maybe some of the employees have been made redundant, so it was able to save few of its costs. So that is why operating profit margin is seen to be increasing one. Look, now there is decrease in gross profit margin, but there is an increase in the operating profit margin. It means that direct costs have not been controlled efficiently, whereas indirect costs, administration and distribution expenses are controlled in an efficient manner. Where cost of sales are increasing by more than 100%, the increase in the administration and distribution expenses is very less in comparison to the sales revenue. That is why operating profit margin is increasing and gross profit margin has been decreasing. Clear? Now, return on capital employed, profit before interest and tax divided by capital employed. Profit before interest and tax could be taken as 400 and 340 respectively. Whereas capital employed, what is the formula of capital employed? Total assets minus current liabilities or non-current liabilities plus equity. So total assets 2580. These are the current liabilities, and non-current liabilities are not there. Only current liabilities are there. So either you can take only equity in the capital employed, or you can take equity plus current liabilities both.
Miss,
Okay, yes to you.
the one which I told you was operating profit margin, not ROC. Like,
26.4
yeah, that one is
operating profit margin.
no, that is ROC.
That has been ROC
Yeah.
400 divided by 1500.
Yeah.
So 400 divided by 1500 is operating profit margin. Yes, it's 26.6. 26.6%. It's okay. Small difference is there. And then 300 divided by 1000. 30. Okay. Then our comments are obviously okay. So 340. 340 divided by 1000. 34%. So it has been deteriorating. Anyhow, so you can just convert the 34%. 34%. So it has been decreasing. It's okay. Okay, now for capital employed, you can either take 1510 or you can take 2580. It can be equity plus current liabilities also. It can be equity plus non-current liabilities also. It can be only equity also. So whatever your wish is, you can take according to that. So which one do you want to take? 1510. Okay, 1510 and 14 multiplied by. So let's calculate all of these. After that, tell me the answers.
So let us sit down over.
0.7. Please recheck if your figures are correct or not. Students, a test has been announced for you people for IFRS 9 and 13, is it? For financial instruments. But I could not take the test today as well. Okay? Actually, I'm just trying to finish the syllabus as soon as possible. So I just request you to do the practice by yourself. When I'm giving you the test, I just assume that you have practiced the exam. Okay?
Ratio of 2001.
Yes, current ratio for 2001? No, it's for 2001, it's 300. Because current assets are, oh, yes, 200, you are right. Current liabilities are how much? Sorry. Okay, current assets are 200, current liabilities are 300.
Well, it's 380, right? It's 380 when we add. Yeah.
No, current liabilities are 300.
But if you add the three figures, 210 plus 70 plus.
Yes, so it means that there is a mistake in the. Is it?
Yeah, so we should take 380, right?
Yes, why did I take 1800? I think total assets I took.
Now, if we scroll down, I can see what yes.
Oh, okay. So it will be how much? It will be 7, 8, and 380?
Yeah.
Yes, you are right. Now, students, you have to finish this question from your homes. You have to do the commenting as well. Just try to see whether you would be able to do the commenting as well. Yes, Amiha, you were asking me the concept regarding reversal of impairment. Impairment is very simple. As per IS 16, whenever we have to take an impairment, it is going to be going in SOPL. Is it? If it's the first time impairment, it is going to be shown in the SOP. If you have shown this impairment in SOPL and if you have to reverse it, if the circumstances are changing, then you have to credit it in your SOPL itself. Okay, if previously the impairment has been taken in SOPL, you are going to give the reversal in the same SOPL. Clear? Now suppose the other condition. If say for example, there has been a revaluation gain on an asset. Revaluation gain as per IAS 16 will be going to the statement of other comprehensive income. If in the statement of other comprehensive income revaluation gain has been there, up to the amount of the revaluation gain, impairment occurs. Impairment occurs, you have to deduct from the statement of other comprehensive income. Is it? Was this a concept of impairment? If there has been a revaluation gain earlier, you have to take an impairment up to the amount of the revaluation gain from statement of other comprehensive income. Is it? Now, if there is an impairment reversal, up to the amount of the impairment taken from the revaluation gain, you have to reverse it from here. Okay, so in this case, reversal will be also taken from the statement of other comprehensive income. Clear? In the statement, in IAS 40, impairment has to be taken from the statement from the statement of profit or loss, and revaluation gain also in the statement of profit or loss. Is it? So in both the cases, impairment will be taken for this. Yes, Sandri, any confusion? In IAS 40, where do you take the revaluation gain? In statement of profit or loss. In IAS 40, revaluation gain is taken in statement of other comprehensive income. So in IAS 16, if revaluation gain is being there, then impairment reversal will also be taken to the statement of other comprehensive income. And if there not has been any revaluation gain previously, first time impairment has been taken, impairment reversal will also be done. And in the case of IAS 40, both the impairment reversals will be taken out of the SOPL only. So this has been done. Clear now? Now students, this is all for today. I just request you to revise the concepts as soon as we are finishing them. I thought to finish one more standard today. That has been IAS 21, a very small standard. But I was not able to do that. So anyhow, in the next lecture, we are going to do this all. And this is all for today. If you do have any confusions, you can ask. Students, in the next semester, how many papers are you thinking to take? Sorry? Yes, please.